Okay, so this is the first case study in the course, and we will focus on major investing mistakes. In these three legendary, I would say, investing mistakes, we'll apply learnings from previous modules, and we will analyze each single investing mistake, what I think the reasons were that led to this mistake, and what we could learn from it for the future. So starting off with the legendary Charlie Munger, and I think he labels this as his most famous and costly investing mistake. It's a very well-known investing mistake in value investing circles, and it is often quoted and referenced by many a value investor. Let me read this quote. A friendly broker called and offered me 300 shares of ridiculously underpriced, very thinly traded Belridge oil at $115 per share, which I purchased using cash I had on hand. The next day, he offered me 1,500 more shares, so 5 times more than the previous day, at the same price, which I declined to buy, partly because I could only have made the purchase had I sold something or borrowed the required $173,000. This was a very irrational decision. I was a well-to-do man with no debt. There was no risk of loss, and similar no-risk opportunities were not likely to come along. Within 2 years, Belridge Oil sold out to Shell at a price of about $3,700 per share, which made me $5.4 million poorer than I would have been had I then been psychologically acute. As this tale demonstrates, psychological ignorance can be very expensive. So Charlie here could have bought a bunch of shares at $115 and sold them 2 years later for 35 times the value. But he did not proceed with that transaction because, as he says here, I could have only made the purchase had I sold something or borrowed the required money. So the mistake here, you can call it a mistake, you can call it psychological ignorance, stuck in your ways. I think the mistake here is that when we enter a position and we feel comfortable with it and, dare I say, love the position and love the company, and we dream about all the money we expect to make, you become committed. And as you become committed to a position, it is very difficult to reverse course, sell that position to buy something else. Even if our current position is priced here, but the alternative position, in this case, Belridge Oil, is priced here, and between the two, there is a massive gap in valuation, which obviously, all things remaining the same, translates to a lot of value over time. Instead of optimizing for this, instead of optimizing for price to intrinsic value, we fall in the trap of psychological ignorance, and we rationalize for our existing position. So, a very simple illustration of this mistake, and after we review the next two mistakes, we will talk more about them and the reasons why each of them potentially happened. So Berkshire Hathaway and Coca-Cola. I will charge this mistake to Warren Buffett. You can definitely fault me for not selling the stock. I always thought it was a wonderful business, but clearly at 15 times earnings, it was a silly price on the stock. So similar dynamics to the previous mistake, but maybe the mirror opposite. So Warren Buffett, Charlie, Berkshire Hathaway, they were very committed. They spent a lot of time understanding Coca-Cola. They were major shareholders, and simply they visualized just how much money they were going to make in the future by owning this company. They knew it could grow volume. They knew it could grow profit per unit sold. They knew it could use its capital to buy back shares, pay dividends. They calculated everything left, right, and center. And they had an expectation what that company would bring them. But as the value, as the price Coca-Cola was selling for went up, then the forward expected returns as the price went up naturally drops. So to explain, if they expected to make 10% at a given price, at 50 times earnings, they could expect to make 4%. So if they were flexible and willing to divest at 50 times earnings, they would net a huge gain on their position and possibly look to allocate to greener pastures, that is, better opportunities, or even sit on the cash and wait for that 50x to go back to 25x or 30x. Basically, they could have traded the business using public markets and the volatility in the stock market. So obviously, in hindsight, now Warren regrets this because I'm sure he kind of calculated the opportunity cost on this, the opportunity cost of just sitting on the company at 50 times or so earnings. And he regrets. So the lesson here is no matter how great the business is, and no matter how much you love that business, there are times when it is prudent to sell and wait or buy something else. Finally, a more modern, recent mistake, which cost Carl Icahn tens and tens of billions of dollars in opportunity cost. And in this case, Carl Icahn sold too soon. So these are two headlines that I chose to copy here. We are out of Apple and it is China's fault. Carl Icahn says he sold entire Apple stake on China woes. So at the time, there was heat brewing between US and China, trade war issues, tariffs, all that kind of talk. And Carl Icahn was scared that any problems on that front would be reflected on Apple stock and he could have lose 30 or 50% or whatever of his multi-billion-dollar stake. The thing here, and my problem with Carl Icahn, and we will see it in the next slides, is that if this is the Apple opportunity, Carl Icahn was overly focused on just a very small part of the thesis. He was sending letters